Understanding key rates in the banking system. The financial world is governed by a complex set of rules, and at the heart of this system are the key interest rates that affect how banks operate and how much credit is available to consumers and businesses. The key rate is an interest rate that plays a crucial role in determining bank lending rates and the overall cost of credit for borrowers. This article delves into what key rates entail, their types, and their implications on the economy. What is the key rate? The key rate typically refers to the interest rate set by central banks, particularly in the United States, by the Federal Reserve, Fed. This rate is instrumental in influencing the wider economy through its impact on lending rates and borrowing costs. Discount rate. This is the interest rate at which commercial banks can borrow money directly from the Federal Reserve. It generally serves as a safety net for banks experiencing liquidity issues. Federal funds rate. This is the interest rate at which banks lend reserve balances to other depository institutions overnight. The Federal Reserve does not set this rate directly. Instead, it is influenced by the monetary policy decisions and the overall economic environment. Key takeaways. 1. The key rate influences the interest rates banks charge their borrowers. 2. The federal funds rate and discount rate are the two primary key rates in the U.S. banking system. 3. Changes in the key rate can affect lending conditions and the broader economy by influencing consumer and business borrowing behavior. Importance of the key rate. Understanding the significance of the key rate requires recognizing how it affects lending and reserve management within banks. Banks operate under a fractional reserve banking system, meaning they are required to keep only a fraction of deposits as reserves. When a bank encounters a liquidity issue, such as when a large number of customers withdraw money, it might need to borrow funds. The key rate determines the cost at which they can secure these funds, either from other banks, federal funds rate, or directly from the Fed, discount rate. Example, liquidity issues. Imagine a scenario where a bank faces heavy withdrawals due to news of possible insolvency. If the key rate is high, borrowing costs will also be elevated, deterring the bank from seeking funds. Conversely, if the key rate is lowered, borrowing becomes cheaper, allowing banks to manage liquidity more effectively. Federal Reserve's role in adjusting key rates. The Federal Reserve plays a vital role in managing the economy through the adjustment of key rates. These adjustments expand the economy. When the Fed lowers key rates, borrowing becomes cheaper, which often leads to increased spending by consumers and investment by businesses, stimulating economic growth. Contract the economy. Conversely, raising key rates increases the cost of borrowing, usually result in reduced consumer spending and business investment, which can cool off an overheating economy. Monetary policy implementation. The Fed utilizes key rates as a primary tool for implementing its monetary policy. To increase the money supply, the Fed may purchase government bonds, thereby injecting liquidity into the economy. The actions taken are influenced by the prevailing federal funds rate, which dictates how readily banks can access funds. Types of key rates, in-depth understanding. 1. Federal funds rate. Primarily used for overnight loans between banks. Sets a baseline for the interest rates banks charge consumers and businesses. Fluctuates based on economic conditions and Fed policy. 2. Discount rate. Set by the Federal Reserve. Generally higher than the federal funds rate, serving as a disincentive for banks to borrow directly from the Fed. Adjustments in the discount rate can signal the Fed's approach toward monetary policy, whether contractionary or expansionary. Economic indicators. The relationship between key rates and the economy can be seen in key economic indicators like inflation, employment rates, and consumer confidence. For example, if the economy is overheating, the Fed might increase key rates to curb inflation. Conclusion. The key rate is a critical element of the banking and financial system. By influencing the cost of borrowing, key rates play an essential role in shaping economic activity. Understanding the functions of the federal funds rate and discount rate provides valuable insights into how monetary policy is conducted and its importance in the broader economic landscape. As any change in these rates can have far-reaching implications, staying informed about key rates is crucial for anyone involved in finance, investing, or economic policy.